Hello, good morning. It's me again. So just going to try something a little bit different. As I said before, want to start putting out more content like this, probably a bit easier for you, the clients. So basically, I want to start adopting a sort of fortnightly market review. So of course, I send out the weekly market review. Some of you read it, some of you don't. I'm sure it's just a spam email for you guys again. But this is going to be a bit different. Going to look at sort of 2 weeks on a 2 week rolling basis. Just give a brief update on what's going on. Just see if we can sort of elaborate a little bit more by doing things like this. So just want to briefly say market sentiment is good. Okay, so current market outlook, investors are quite happy. S&P itself is up 6.18% year to date. Last 12 months performance still down 6.15. Okay, so still got a little bit more room to go till we're back at a level sort of seen this time last year. Good week in the markets overall. And the outlook really is that it's going to be a soft landing for the US economy. European gas prices are improving, so that's looking like that's going to come down quite nicely. Still some lagging data coming out, so consumer and retail data for December was quite weak. Bit unusual considering the festive time of year, but that really highlights how badly inflation is affecting the retail investors, the everyday people. So really key just to keep focusing on that, see what happens in the new year. In my opinion, we're looking at a market recovery towards the end of March. It's going to be underpinned by interest rate increases slowing down. Major central banks are going to take it a bit easy coming into the middle of the summer. And actually, we could potentially be looking at interest rate decreases towards the end of the year as we see inflation sharply come down. Central banks are still trying to keep inflation at their 2% target. That's always been their target. Of course, it's very hard for them to hit that. And if they go too aggressively, they're going to cause recessions. If we do see interest rates start to drop off, okay, really important thing, something that we talked about during COVID and zero interest rates was, well, if you keep your money in a bank, inflation remains at 2%, okay, well, you're potentially losing 2% a year. So it's key that you have a look at some opportunities, whether that's fixed deposits, locking in money for a period of time just to gain returns, because the last thing you want is just the money sat in the bank and eroded away. Wanted to highlight something that's key for some of you investors, particularly if you're dripping money in on a monthly or quarterly basis. But if you'd invested in the FTSE 100, it's been flat for the last 4.5 years. But if you had reinvested the dividends that were being paid out, okay, you're actually up 20%. And that just highlights the power of compounding, the power of dripping money into the markets and accumulating the wealth over the longer period. China has reported much weaker GDP, 3% compared to the target of 5.5%. And that's largely due to pandemic restrictions. Now, as we see China opening up, restrictions are easing, they're traveling. We are seeing that manufacturers are actually importing more raw materials. That means that things like coal, copper, and iron prices are remaining pretty steady, and therefore commodities are not necessarily going to see drop off right away. Need to watch how China opening is going to affect inflation. Of course, they're coming out. They've been sat on cash for the last 2 years, so they've got money to spend. That could potentially push up prices, therefore maybe nudging inflation up, particularly if they're traveling to other countries and regions. And the real key about that is, we have potentially recession in the Western world. If we look towards China, probably going to start getting high inflation as it opens up. If you look at Europe, prices are easing. So we've got a real mixture across the board. Real big key for you guys as investors, need to remain diversified, look at different asset classes, which I do with most of you. None of you are too crazy in terms of looking at some really out there investments. And it's good just to have a spread mix across equities, bonds, fixed income, other fixed income, even money market. One thing that I do want to highlight, though, is sitting on cash. That sort of tries to say that you're trying to time the market. You've heard me say it once, you've heard me say it 100 times. Trying to time the market is impossible. Okay, so we never know what's going to happen. It's about time spent in the markets, not timing the market. And it's important that certainly if you're dripping money in, just continue doing what you're doing, because what you buy now in over the next few months while we've got some volatility will definitely increase as the markets recover. So keep an eye out. I'm going to start doing this every sort of fortnight, try and drip feed in information. It's my opinion. It's also mixed in with fact. And let's just see. If you like this, let me know, please. It does help. And if you've got any questions, please contact me directly. But key messages are: markets are on a good rebound. Still act cautious. Remain diversified. Don't keep money in the bank. It's going to be eroded by inflation. And just keep doing what a lot of you guys are already doing. All right. Thank you very much. Have a good weekend. Cheers.